Socials here. Hello, Smart Money Street podcast listeners. Welcome to this week's show. My name is Kurt Chisholm, and I'll be your host. And today I'm joined with Phil Weiss. Hey, Phil.
Hey, Kirk. Happy to be here on this sunny Friday. Much better than we had for Memorial Day weekend, that's for sure.
Heck yeah. my phone says it was supposed to rain yesterday through the next 10 days, but it hasn't, which I'm very thankful for at the moment.
Yeah, it's been a little wet lately.
Take it when we can get it.
Yes.
Typical spring in New England. I know you're not in New England, but it's for us. It's very typical.
No, I know I have some friends that I was talking to earlier that are going to Cape Cod, and he said they live in Arizona and they come east and north for the coolness. And he goes, but it's supposed to be cold. We have to, we're shipping clothes because the weather is so cool there right now.
Yeah. I would say Cape Cod's great in July and August. I don't know about June. When we were in during COVID, when we were down there for April, May, and June. And June was fine, but April was really rainy and windy. May was decent. June was hit or miss, but July and August were phenomenal. Like we go in August. It was the best time to go. But anyhow, so yeah, we're this is the last day of May in the markets anyway, and as of Monday it'll be a new month, and it's been a crazy ride here this year. Every month has a different theme, which is kind of funny because it's almost to the day. January was gold and silver month until the last day, and then it was anti-gold and silver month. February was everything month, and then March was the war and it was terrible, and then April was everything. Well, not everything's up, but markets turn around in April, and May has been technology month. Pretty much, yes. Technology's been going up. Who knows what June's going to unfold? But we have some sneaking suspicion it's going to be SpaceX month.
Yes, we do. That's the rumor.
So tell us a little bit about SpaceX, Phil. I know you've done a little digging on this.
Yeah, so assuming this happens, and the word that I'm seeing from at least the newsletter I get from Ed Jardini is that they expect it to price around June 12th, so we'll figure the middle of the month. They're expecting it to price at $1.75 trillion, which would easily make it the biggest IPO ever. The company released its S1 recently, and this is something that just boggled my mind when I read this. Jardini says that the company cited a total addressable market of $28.5 trillion, which is larger than the entire U.S. economy in its S1. And of that, 22.7 trillion is attributed to AI enterprise applications. And I don't know, that's just, if you look through the details of the S1, it's really hard to come up with anything close to this kind of value because most of the business is not profitable. It's not it's trading it at that price. It would be at 100 times revenues. That just seems really excessive to me. Facebook came out 10 or 11, just to give you a frame of reference. And then there's some people I know, I've seen a lot of concerns, including there's a website, an analyst, The Blind Squirrel is his website, and he wrote a whole thing about this, about the S1, and talked to, and there and elsewhere I've seen how typically for a company to be included in an index, it has to be profitable for several quarters in a row. I think it's 4. And it has to have at least a year of trading history. Well, you got this case where, look, $1.75 trillion, and there's kind of likely to be a lot of interest, but not a lot of shares traded on this stock. And the NASDAQ 100 index is saying that they could let SpaceX in 15 days instead of, and it's not profitable yet. And you think about it, if the S&P follows suit, then what happens, right? And now you got a $1.75 trillion company. That means it has to take a big spot in the index, which puts pressure on other stocks. There's lots of things that can happen here. And even the lockup period for the shareholders, the founding shareholders, whatever you want to call them, the shareholders of the private entity, the same lockup rules don't apply. So they could be selling their shares. There's just a lot of questions to me that this raises. It's not your typical transaction. And I guess we think that Elon's involved, and usually when Elon's involved, there's things that are different. So this is no different in that regard.
We call those shenanigans, Phil.
Yes, I was trying to be nice.
Shenanigans, yes. So Saudi Aramco was the largest prior to this, I believe. I don't know what happened with that in indexes, but I don't know if you've looked into this, like other IPOs like Facebook or any other big ones that have come out, like what they did with those. I assume they also didn't put them in the index right away.
They didn't, and Saudi Aramco wouldn't go in the index because it's not a US based company, and a lot
Right.
of the indexes have rules that say they have to have US base or at least a certain amount of US trading. But no, it's always, my understanding is it's always been at least a year and at least 4 quarters of profitability. I mean, it took a long time for Tesla to make it into the S&P 500 because it wasn't profitable, and they waited until it was. And if you
Wait,
look
it
at how
is?
much that company is, yeah,
Wait, when did
well,
that become profitable?
well, whatever that may be, maybe it had that brief moment, but it took a long time till they added Tesla. And like, you could argue that not putting it in there penalized index investors because weren't exposed to Tesla when it had a lot of growth. But it took a long time, and so this is something new, and it's got a lot of people up in arms.
Yeah, it's going to be a very interesting thing. I mean, I think it was slated for around January 22nd, I believe. Is that it comes out what, on the 15th or something that they say when the date is, or how does it work?
I don't know exactly. I mean, like I said, I'm reading here that they expect it to price around the 12th of June. So you would think it's going to come to market not long after with a very light float. I mean, the percentage of shares that are actually going to be part of this is pretty small too.
Yeah. Yeah, I've gotten a lot of questions from clients in the last 9, 12 months. How can we get a part of SpaceX? How can we get a part of SpaceX? And I feel like saying to most of them, I said, look, you already missed it. Like
Yeah.
if you're buying it now before it goes public, you're done. The reason the companies go public is because the stock is well in excess of the valuation, and they want to cash out and raise some capital, but they're not going to do it at a discount to what it's actually worth. So if it's going public, back in the late 90s, when everyone wanted access to IPOs because it was cool and hey, it went up 100% in a day or 200%. Well, that's great if you can sell it in a day. But realistically, I mean, look at Facebook. Facebook went public, and went down for like 6 months or 9 months or whatever it was. And then once they announced, oh, we're going to do ads, then it started to go up. But it was down like what, 30, 40% or something crazy?
I think it was more than that because I know at one point Facebook, I want to say it hit like $18 or $20. And like, that's you're raising a point that's so interesting to me. It's a big fundamental change in the market. The companies that we think of, like these mega cap companies now, Apple's a great example. And I have a client, her father bought shares of Apple 3 days after it went public. And after her father passed, her mother held it. And like, her mother passed, but those shares are still there. And the cost basis in those shares is 14 cents, right? But Apple, when it went public, it didn't come public as a $1 trillion company or even $100 billion company. It came public as a small cap, and it's changed. Now there's so many more venture capital and private equity investors than there used to be, that these companies don't need the public markets for funding. I mean, biotechs I think of as the exception because they have ongoing needs for R&D, and it takes a long time till they have a product. And so they can often need help more than some of these other companies. But some of these companies, by the time they come public, we've missed a lot of the growth. I mean, you can think like Airbnb went public as a $50 billion company. Well, Facebook wasn't as big as that because it was before that, but the company and Google wasn't either, but they were still much bigger than Apple and Microsoft and companies like that were. And like, over time, so many companies are getting bigger and bigger, at least the ones that we've heard of, and at least the ones that make their mark. I mean, sure, there's still some small companies that go IPO, but companies are also somewhat hesitant to go IPO because there's a lot of cost and time and money that's spent when you go public, because now you have reporting requirements and filing requirements and everything else. And a lot of companies don't want to be bothered with that. And now when they come public, they have to be.
Yeah, it's a great point, because if you look at something like Twitter, when Elon took it private, Part of the reason he took it private was to, make the changes. But part of the reason is he didn't want to have to go through public disclosure all the time. It's easier just to have a private that you don't have to worry about shareholders. He had his own investors, and I assume Horowitz and Dreesen, probably a few other people backed it and took it private. I don't know exactly who it was, but I heard that he was one of them. But there's probably a bunch of people who took it private, and that's okay. You got to deal with those people and no one else. But when you're working with the public, everybody knows you have all, like you said, reporting requirements. It's getting a lot more onerous to be a public company nowadays. Now, there are some benefits to being a public company, but there's certainly a lot of drawbacks, especially the more regulations they put on public companies. So what I've told most people about SpaceX, I said, just wait till it goes public. Wait till it goes public, buy a small share if you're interested, right? Just, wait a week, see what happens, because most likely you're going to see a run up probably that day. And then you'll probably see a sell up because a lot of funds want to get in, or they're already in, and there'll be some sloshing around of things. But I think it's probably unlikely it'll first day public it'll go into these big indexes. I think that would be a real bad idea because there's too much movement that needs to happen, right? So if you think of it this way, let's just say, for the sake of argument, SpaceX has 100 shares and it's putting out 50 to the public. This is completely made up numbers, just for example. So you're putting out 50 in the public. Well, out of that 50 shares, there's going to be retail investors, there's going to be institutional investors, there's funds, there's indexes, there's ETFs, there's miscellaneous large pools of money that want to get access to this. So if there's not enough shares, then it's going to drive the price way up. If there's too many shares, it's going to go down. But the reality is people move money around. So when a company goes public, mainly some institutions and retail public want to buy it. It's not until like the indexes and the sectors and these big pools of money come in that want to buy it, you have to wait till it's stable. Because if everyone is trying to buy 50 shares at the same time, the stock's going to go through the roof. And I don't think anybody wants that, because once they all stop buying, then it crashes. And then what good was that? The markets like predictability, right? They like stability. They don't like uncertainty. And so when you have stuff like this, I don't know what's going to happen, but I think it'd be a very bad idea to just all of a sudden throw everybody in a room and say, all right, let's bid it up to the moon. It's just, pun intended, but you get the point. So you want to wait. And here's another thing: about 6 months, the employees are allowed, typically after going public around 6 months, I think it is, the employees are allowed to dump their shares. Well, if you've bought a share for $1 and now it's at $100, after 6 months, you want to cash out. I want to go buy that new house, that Ferrari I always wanted. And so they can go out and sell their shares. And so you get a lot of people dumping shares, and this has happened with a number of companies. I remember Uber, for example, when it went public, I had a bunch of clients who worked at Uber, and they wanted to sell the shares. And I was like, you might want to wait, because as soon as they were allowed to sell their shares, the stock price took a dive. And I was like, just wait, it'll come back. People are going to buy it. They'll buy the dip at wherever that's priced. And it did, and it came back, and all of a sudden everything was great again. But, the problem is when you don't understand these money flows, if you will, these dynamics of markets, you get caught in this FOMO of, I need to own SpaceX at any price. Well, that's dumb. How do you even know what the financials are at this point, right? How do you know, a lot of things? You're just getting initial information. You have no history. You got a handful of information from the S4, not the S4.
S1.
S1, yes, S1. So you get some information, but really what you're trying to do is you're trying to get some stability in it, so you could see approximately how the market's seeing it. And once you have that stability, now you can judge, okay, is this something I want to buy? Because look, if the PE is at 1,000, why do I want to buy it? We'll just wait. Till it drops a lot, and then say, okay, now's a better time. But that's how you should be thinking about IPOs. You shouldn't get caught up in the FOMO. Everyone else does. Just wait, right? You don't need to. Let me just say something, because I know it's going to freak everybody out. You don't need to own SpaceX. You don't. If you don't own it, the world's still going to spin. You're still going to have a job. You know, you'll be fine if you don't own SpaceX. Okay, it's not the end of the world. Okay, just because your neighbor owns it, it's okay if you don't. As long as you have that attitude, then you can look a little bit more logically about the right price and how to buy it if you want to buy it at all. But I would imagine we're going to see a lot more craziness leading up to 3 weeks from now, when supposedly when it goes public. So I would argue that everybody should just take a pause and just be careful about your next moves. I do think that certain areas of the markets are probably going to be bid up prior to SpaceX, right? The space sector, I would assume, it has gotten bid up a lot, and I
Yes, it
expect
has.
that'll probably be bid up even more going into that. After that, no idea. But leading up to that, you know, it probably will. That's typically what happens, right? Buy the rumor, sell the news, right? So it's going up. It's gonna go public in 3 weeks. Great, buy the rumor. Once it goes public, sell it. Like, that's how the markets work. I'm not saying SpaceX. I'm saying just in general, that's how markets work. So I would tell everybody that if you're looking at, we're going to get into this in a minute. I'm going to give Phil a chance, but we're going to get into the sectors and how they're doing this year. And I think you're going to be shocked. And I want you to sit down so it's easier to pick your jaw off the floor. Because I think a lot of people misunderstand what's going on in the markets. They see the index return, say, "Oh, the market's doing great." No, it's not. The index is doing great in one sector, more specifically one subsector. but we'll get into that in a minute. So, Phil, what kind of things are you seeing out there? What's interesting to you right now?
I mean, SpaceX is interesting because it's such a different story. But beyond that, like, you're right. We see, if you look at the market, like, I'm pretty sure I know what sector you're going to talk about. It's got to do with either semiconductors or memory chips. Like, one of the others, like Micron Technology became the first not the first, but past the $1 trillion market cap number. And that's a company, like, that's a stock that if you look at it over time, it has its highs and it has its lows. It's not a company that's been stable in terms of performance, but there's just such demand for that kind of product. So there are some things they're doing well, and there's software stocks have been killed, a lot of them, because they're afraid about what's going on with AI and whether or not AI can take over their business. So it's been interesting, like you said, from month to month we've seen different things. I mean, there's been times this year when value looked really good and value hasn't looked good for a long time, and then now we got tech and we're back to growth and AI, and so the market is moving a lot more quickly. I mean, that's something we've noticed over the last few years, because if you go back like to 22, or you go back to last year in April, when we had all the concern about the tariffs, and when the market's gone down, it's recovered really quickly. The rides down have been fast, the rides back up have been fast, but the market overall, like, if we go back to the lows of 22, the market's more than doubled. At least the S&P has more than doubled from those October lows. And for the market itself to double in 4 years, that's less than 4 years. That's a pretty quick move for a market. And, like, it's interesting. I mentioned Yardeni, so he talked about it. It's not just FOMO. It's like, we have a lot of earnings momentum. Like, if you look at the first quarter earnings for most companies, they were really good. There's a lot of growth, and the expected growth, and whether or not that actually happens, was really strong. And so that is one of the things, like, fundamentally, you can argue that a lot of what's happening in the market where we see companies do well is because of the earnings. And, like, will it last, right? Because you've got companies that have historically generated a lot of free cash flow, and free cash flow is basically their earnings less their capital expenditures. So it's like the money that they have left. Well, some of these companies that are involved in the AI businesses, historically, they generated a lot of free cash flow. And now you look, and they're spending billions of dollars on CapEx because they want to participate in this AI revolution, for lack of a better way to explain it. And that's changed the profile of these companies. Like, there's lots of things like that are happening. So it's a really interesting market to me, because there are a lot of things that are different than what we've seen in the past.
Yeah, it's make a good point. You know, we had a really strong earnings season this past quarter, and in the last month or so, really strong earnings season. And there's What's interesting to me, so I read this thing the other day and I thought it was really interesting. Um, in the past 2 years, 92% of economic growth in the US came from productivity, 8% came from labor input. Now, alone, you might say, is that normal? I have no idea. Well, here's more what's normal. Okay. What's normal is more of an even split, 50-50. Okay. At technology peaks, it's typically 70% productivity and 30% labor. So now it's 92-8. Does anyone think that that's a problem? I don't know, but I know that if labor can't keep up with everything else, that is a problem. That's what we call inflation, right? If if labor keeps up with everything else, then it's not inflationary, right? If you're earning 10% more than you earned last year and prices go up 10%, it's a wash, right? But if prices go up 10% and you're earning the same, now you're 10% poorer, right? So there needs to be some balance out there, and right now there isn't.
Mhm.
Now, I'm going to share a few things here. One is I meant to do this last time, but it didn't have we kind of ran out of time. So, right around the start of the Iran regional conflict, the Central Bank of Turkey sold 120 tons of gold, more than $20 billion. And they use that as a way to secure liquidity and to secure the currency, basically. And some other countries have done the same. If you look at Russia, Russia has done the same. This is what Russia has done this year. This is, I think, the first time in a while where Russia has dropped their holdings. They've actually been increasing for like the last 25 years. So it's actually interesting to see them decline at all. But what you're starting to see with the Iran war is that a lot of countries are shoring up their currency, and in order to do that, they're selling gold. Now, what's interesting is a lot of them, especially Russia and China, have been buying gold for like the last 25 years, and that in itself shows that they're smart enough to realize that they need gold to shore up their currency and their economy, just in case. I mean, if you look at Russia, people think, "Oh, Russia's economy is a mess." Yeah, but their debt is like 20% debt to GDP. Ours is what, 120% debt to GDP or something crazy. Japan's is like 300 or 400% debt to GDP. And Russia learned its lesson before, in that they didn't want us to capsize their economy with debt, so they're just low debt. That's smart on their part, right? They own a lot of gold, so a lot of these countries are in a position where they're having to sell assets like gold in order to shore up their currency. Here's another chart I saw, which was interesting. It's the market cap of the top three stocks: Nvidia, Google, and Apple, and the market cap of gold and silver. So the market cap of gold is 32.6 trillion, 5.5 trillion for Nvidia. Silver is 5 trillion. Google's 4.8 trillion, and Apple's 4.4 trillion. I find this interesting as well, just to see whether those numbers are right or not. I don't know. Like, should gold and silver beat those prices? Should Nvidia beat those prices? I don't know. But it's interesting to see in perspective where everything is. So, as a hard asset, if we do have inflation, you want to be in hard assets, right? You want to be in commodities, you want to be in precious metals, you want to be in infrastructure. Those are the areas that should do well in inflationary times. I know a lot of people are worried about that. We've had a big to-do about that in the bond markets recently, although they've kind of receded in that tension. So we hit that barrier, that 5% barrier in the 30-year, and the 10-year hit its own barrier. I think it was like 4.6. I think it got to 4.5. I forget what it was, but whatever it was hitting a line in the sand that a lot of people were calling for. It has since receded from that. Whether we continue to push against that, I don't know, but we talked about it last week in bonds and how they're impacted. So a lot of people are worried about bonds. I think we're at a point right now, we're at that line in the sand where they don't want it to get worse. So we'll see if that does. I don't know, but if it does get worse, that is a different scenario. We talked about this a few weeks ago, scenario thinking. One scenario is high inflation, rising interest rates. Scenario two is lower inflation, dropping interest rates. And those scenarios are almost opposite of each other. What you do in one is the exact opposite of what you do in the other. So how do you choose? Well, you don't. You just wait. You just wait till the market tells you which one is correct. And we started to dip past the high interest rates a few weeks ago, or in the last few weeks, but it's receded. So we should be, at the moment, we're not seeing things go crazy. But I'm still waiting because it's receded, but it hasn't exactly gone the other way sharply. It's still kind of hanging out there. So while we have this regional conflict, quote unquote, going on, um, you know, things are going to get squirrely. As soon as this wraps up, then I think people are going to start to see, all right, things are going back to normal. It will take a while for them to go back to normal. Like oil prices aren't going to go down to $40 overnight.
Probably
Um,
not.
a lot of reasons why, but we'll actually want to get Phil's take on that because Phil's the oil expert. But it shouldn't go down that quickly right away. But people will feel better, right? And inflation should recede a little bit. And even though they were not going to get their goods tomorrow, it might take a month or two to get them from the Strait of Hormuz. But people will feel a lot better about that, and they can kind of figure it out. Earnings season next season, I think, is going to be rough for a lot of different companies. But we'll find out how rough it's going to be as soon as the war is over, which, according to Trump, we're one word away from it being over. It'll be like one period. Next week is one period away. We're almost there. Like, come on. Oh, I think I lost Phil there. Got a different camera on.
Yeah, I know. Sorry about that. I'll fix
Okay,
that.
no
I don't know
worries.
what happened there.
Anyway, so I wanted to let me share this. So you don't have to look at Phil's legs. For the global money supply, I think a lot of people haven't realized this. We thought that the quantitative easing was dead and there's no more increase in money supply. But I don't know. Look at 2025, 26. Look at that huge increase in money supply, about $17 trillion. I didn't realize it had been that much. I was a little shocked to see this, but it sure lines up, right? The markets went up crazy last year, and they're going up crazy this year. Well, the index, and we'll get into why that's happening. It's not necessarily everywhere, but it's important to note what's happening because typically increase in the money supply equals increase in stock prices. Typically, not always, but very frequently. So it's something to keep in mind. Now, before I get into my dissection of the markets and what's going on, tell us a little bit about what's going on in the Middle East, Phil, with oil and what your prospects are for what's going on there.
Sure. So certainly we've seen an increase. I know as you said, we're maybe one period, whatever it is, away from ending the war. So prices have pulled back a little bit, but oil prices in general have gone up. And that's a big driver of inflation because people often don't think about how many different things oil affects. Because oil isn't just something that we put into our gas tanks. And it's not just something that's used for fuel on the airplanes. Oil goes into plastics. Oil or natural gas, some type of hydrocarbons are needed for fertilizer and for growing our crops and then for moving them around. So it affects food prices. Plastics are in so many things. It affects a lot of different prices. And then with the Strait close, like I was actually reading that while oil prices have pulled back some, aluminum prices haven't. And aluminum goes through the Straits of Hormuz too. So there's lots of things that are being impacted by what's going on there. And it affects their availability. And the ships that went through the Straits, they're not sitting in the Straits waiting to transport oil. So it takes time to move the ships back. It takes time. We've gone into reserves. It takes time to get back and restore product flow to what it was. So I just don't think that there's any way that the war ends or the conflict, whatever you want to call it, that it ends and we go back to 40, 50, $60 oil prices within the period of a few weeks. I think it's going to take months, maybe a year before we get back to a more normalized environment because it's not like this is something that can just be fixed right away. And you've got a lot of things get shut down and it's not like they can just restart. So it's going to take time, and oil just has such an inflationary impact, and it's on so many different things. I mean, we had one of our HVAC systems is on the fritz, and we had somebody in to give us a quote, and it's for a much smaller unit than the last time we had to replace one, and the price was more. And we're like, how can that be? And like, well, that's what's happened. We put the other one in during COVID, which was a time that they started to raise prices on things. And now a smaller unit, because it's for our basement, not for the main floor, costs more than it did to replace our main floor unit during COVID. And he's like, that's just what's happened to prices. Well, they can say that, but that doesn't make it any easier to pay for it. And it's like, there's some things you just can't avoid, but food prices have gone up a lot. There's so many things that have gone up, and inflation does have an impact because, as you were saying before, Kirk, if your salary doesn't go up as much as prices go up, you're falling behind. You're not moving ahead.
Yeah. Yeah, it's going to be very interesting to see how this plays out. And those of you who listen to the show know that I'm giving Trump an A plus on persuasion on the war point of view, because when we went to war, which nobody expected, but when we went to war, people thought it would be like Venezuela and it would end right away. And then he came out and said, well, it'll probably be 4 to 6 weeks. And then people gave him a long leash and said, all right, 4 to 6 weeks, that's fine. And then it was 4 to 6 weeks later. And then it was like, all right, what's going on? He's like, well, we're almost wrapped up. We're just trying to do, like he pulled his shenanigans, and people are like, oh, okay, it'll be wrapped up tomorrow or the next day. And then the next day happened, And now we're looking at March 1st until the end of May. We're looking at 2 months, right? We got actually 3 months.
2 months.
Right? 3 months. Shit, I didn't realize it was that long. 3 months into the war, and people think it's going to end tomorrow, and I'm included, right? It's hard to make investments or bets on what's going to happen when you don't even know what's going to happen, right? Now, if we had a forever war, I'd be like, oh, there's the defense contractors. They're going to get plenty of money for the next 50 years because that war is not going to end. And then, this is going to happen because this isn't going to end. You can predict this stuff. With Trump, you have no idea, which is the point. This is exactly what he's trying to do. He might have thought, well, this is going to take 6 months, but he says it's going to take 4 to 6 weeks. And then each week he comes up with something else. Well, we did this. And he's like, we destroyed their Navy. And the next week we're like, well, a few boats got hit. I'm like, what do you mean? I thought you destroyed them all. Like all this stuff that we're hearing. It's, true, not true, sort of true. It's what we call a half truth, right? There's enough truth to it, but it's not 100% true. Now, this is what, year 6 in Trump? We know his half truths. Some people still are upset. We call them Democrats. They're still upset that Trump's, quote unquote, lying to them. Okay. Where like any politician doesn't lie to the people. Like, give me one that hasn't lied to people. But what they're upset at is he doesn't represent them, their sensibilities, right? Which is a big part of it. Because all politicians lie. But what Trump does is Trump does it in a way that's directionally accurate, right? So when he said, we're going to build a wall, he didn't mean he was going to actually build a wall. I know people got upset. Where's the wall? Like, it wasn't about the wall. It was directionally, we're going to focus on illegal immigration. But if he just said, we're going to have drones, we're going to hire more people, and he said all this stuff, you'd be confused and be like, I don't understand. He said, we're going to build a wall. People are like, yeah, we're going to get a wall. The concept was a wall, but it wasn't in actuality what he was going to do. And so when you understand that, and I'm not justifying anything he says, because I know we have Democrats, Republicans, Libertarians, everybody listening to the show. This isn't about politics. I'm just explaining what he's doing. You don't have to like it. This is not policy. This is just explaining the concept of what he's doing. Okay. So when he's up there and he's saying, we're going to do this, he's basically persuading you to think directionally in that direction. Right. And so, yeah, we're going to go after the nuclear weapons. They're really bad. Well, is that the only reason? Probably not. There's probably a multitude of reasons that we attacked Iran. And it's not because Bibi convinced him and coerced him and all this. There's like 50 million reasons why this is happening. It's not just like, oh, he just flipped a coin and decided to shoot Iran today. No, it's complicated. We'll probably never know all the reasons, right? So just keep that in the back of your mind that you're just never going to know all the facts. So when we look at doing something like this, how do we discern whether this is going to stop or start next week, next month? Well, I think we can all agree that if this goes on in the midterms, he's going to have more problems than he has today, which is it's not looking good for him right now. Now, if this ends relatively soon, he could probably turn this into a victory for himself and maybe even gain some ground in the midterms. I don't think Republicans are going to do very well in the midterms based on this, but we'll see. It's still early. We still got a few months. So how do we figure out what's going to happen from here? Well, based on what they're saying, if we, and we'll talk about this in a minute, if we look at like sectors, the oil price has actually been a pretty good determinant of where the war is going, right? It spiked up, it hit a high of, where was the high? I'm looking at the ETF. So it hit a high of right around 120, just shy of 120. Right now it's at 86. Prior to the war, it was at 65 approximately. So it's really a lot lower than you would have thought, right? You would have thought it would be even higher now, even though the war is still going on. But especially in the last week or two, it's starting to decline, which means that the oil markets, the future traders, people who know a lot more than us retail people, they're seeing that the probability of this ending is really soon, and we think that the risk of oil being high is lessened. So it's a good thing to look at and say, okay, here's the way all the smart people look at it. There was actually a point where it got down to, I think, about just shy of 80 in mid-April, April 17th, I think it was, where it got down to around 80. So we've seen a lot of spikes. We've seen, it go back and forth. But the thing to keep in mind is this, all right? When we're thinking about the Middle East war, does this impact your stocks? Because it may not, right? If you're talking about, I don't know, let's say Starbucks, right? Starbucks should, I don't think coffee has anything to do with the Strait of Hormuz. I don't know that for sure, but let's just say, then Starbucks won't be affected by it. So does the war really impact your investment? Probably not, right? Inflation, yes, especially if you're in a high-end consumer good. Yes, that would be an issue. But is it going to impact your toilet paper or your paper towels? Probably not, right? It's probably not going to impact that. So would it impact certain parts? Maybe, but overall, it's not like oil is. Now, if you're talking about fertilizer, as Phil says, or plastics, or just gas in general, yeah, you're going to have an impact. So maybe trying to speculate or invest in those areas is not a good idea right now, right? You could have said, well, I don't want to invest in energy sector because energy prices will go back down next week, as Trump said. Well, okay, energy is not the best sector anyway. But if you look at the energy sector, I'm just going to pull it up for a minute and I'm going to share it with you guys. Where is it? It started to go up last year. It started to go up in December, actually, January. It started to take off, and it's certainly lower than the peak it was at the end of April. But energy is not the best sector anyway. So is it too late? I don't know. I think most of the speculation is probably gone. Will oil prices go down a lot? Probably not the way it was before. At some point they will. At some point we'll have a glut on the market and the prices will be suppressed. I don't doubt that, but I don't know when that'll be. Phil would be a better person to ask about that. But when I'm looking at investing in certain areas, I'm looking at where are the opportunities. I don't know that great opportunities are in energy right now. There might be infrastructure building, things like that, in the Middle East, but overall, I don't see the opportunities there. I think a lot of people haven't, especially since the energy sector is like 3% of the S&P 500. Maybe it's 4 now with the war, but it's not very high. So if the energy sector didn't exist, if it went to zero tomorrow, you'd see barely a budge in the index. So, I think that if you're looking at opportunities, the question asked is, does the war impact them? And, is the war ending or continuing going to impact your investments? That's an important question to ask yourself. And the hard part is determining whether the war is going to end tomorrow. So I don't know. What are your thoughts, Phil?
If the war going to end tomorrow, I'd be surprised, right? But I mean, energy, like if you look at some of the energy companies, like they're trading at levels that they haven't been at for a while. You're right, it is a very small part of the index. I think at its low, it's been as 2%. I think it did get closer to 4% of the S&P because of what's going on right now. But it's not an easy sector to invest in. Like I remember when I covered as an analyst, like it wasn't the best sector. And you have to, like, I would focus when I'm looking at energy companies on what their costs are, because in economic terms, we have two things. We have price takers and price makers. Price takers, they basically have to take whatever price the market gives them for whatever they're selling. And that's what oil companies are. Price makers are things like technology companies and healthcare, the pharmaceutical companies, things like that, where they can kind of say, here's our product. If you want it, this is what you're going to pay. Right? Like Nvidia, when it's selling its chips, there's a lot of demand. It can kind of set the price. When Exxon's selling oil or Chevron's selling oil or any of the majors are selling oil, they don't really set the price. The futures market sets the price more than anything else, and they have to take what the price gives them. And if you look at the energy sector overall, like at the bottom of that price taking chain are the refiners, because they are selling the ultimate end product, and whatever the market says, that's what they take. They don't get to say, hey, I want to sell at different price. I remember when I used to be a tax person before I was even an oil analyst, I used to do transfer pricing work, which is looking at how much companies should be charging for goods that they move across borders. And I remember one of the companies I worked for, they had a affiliate that produced acetic acid. That's a commodity. It's not oil, but it's still a commodity. And one of the things that they said was, if I'm selling somebody acetic acid and I'm selling it, I'm just making up numbers. It doesn't really matter what the real number is, for $9 a gallon. And somebody else comes and sells it for $8.99 a gallon. My acetic acid is no different than theirs. It's really easy for them to switch and buy it from that lower price. So that's why you're the price taker. You're not making the price. And so that happens with that's a really important part of the oil industry and why it's hard. So that's why when I look at oil investments, I look at what their cost structure is, because the lower your cost is, the better your cost structure is, the better chance you have to make profit. When prices are high, you make more. When prices are low, at least you have a chance to make something. And some companies, the way they run, still don't make anything. It depends on how they run their operations and how they look at things. But it's a tough sector to invest in. But you have to think about these things. It's all the second order effects, right? When we talk about higher oil price, remember, it's not just oil and it's not just our gasoline, it's our food and it's the plastics and it's like the asphalt that used to pave roads. That's a derivative of the oil refining process. So you have to think about some of the other things that are affected, but also how do the companies make money?
Yeah. So I'm going to share kind of what's actually going on in the markets, because I think a lot of people have misconstrued what's happening. So I'm going to go through each sector of the S&P 500. I'm not going to go through real estate. I can pull it up later, but it's not as exciting to a lot of people, and it's not a big part of the index. All right. So this is the materials sector, right? This would be commodities, commodity producers. This is materials sector. Now, if you see here, you've seen basically 2025. These are all 1-year charts, by the way. So this you're just looking. So this is 25. Didn't go very much, didn't go very well, and then you started to see it take off right around in December into January, and then you had the war start, and then it's come down. So pretty much it's gone virtually nowhere for quite a period of time, and it peaked out in I think right here was February. So it peaked out in right before the war. Actually, the war started and it declined. Okay, it declined after the war started. You'd think it would go up because commodity price went up, but it didn't. It declined. So basically, for the most part, you'd see, wow, well, the material sector's up a lot this year. Yeah, but it's really what we call going sideways, marking time. So was it up in the first 2 months of the year? Yes. Is there a trend up? No, the trend is sideways at the moment. So when people get excited because they're like, wow, materials are up like 10%. Yeah, but I wouldn't call this a good trend to invest in, because if you're buying it now, you bought the first 2 months of the year returns. That's all you did. And the rest of the time, you're just kind of waiting. When the trend starts like this again, okay, that'd be a good time. But if you were invested earlier last year, you pretty much were biding time as well. It wasn't until it broke out right around actually January 1st, January 2nd, 2026 is when it broke out. So that's materials. Okay. Here is industrials. Wow, doesn't that chart look almost the same? Yeah, it does. It's pretty much the same chart. They're a little different, but look at that. Almost mirror images of each other. Went up right around January, took off, and then the war started, went down. Now it's kind of back biding time again. Okay. Two sectors that have both done very well this year are basically marking time. Here's another one. This is staples. Okay. Similar, where it did well in the first 2 months and then it got creamed, and it really hasn't come back as much. Staples have been partially because of the war. War has impacted staples quite a bit because of shipping costs, and so that was a little bit more squirrely. And these would be like retail companies, but this has been one of the more poor performing sectors of the year. It is. Yeah, it's up, but it's not up a whole heck of a lot. Here's utilities. Well, utilities are typically boring. Utilities, that you get like a whatever, let's call it 7% a year return. It's you pay your utility bills and they make a profit on it, and they can't overcharge you. So they've got a profit margin built in. People look at them as bonds. They're an equity version of a bond. So if the utility is paying a 4% dividend, that is going to equate to, let's say, the 10-year. So is there growth in some of these? Yeah, in some of them, but a lot of them, not much. And so you tend to see a very flat environment for utilities. Now, if interest rates are going up, utilities are going to start to go down. And look at that. They've started to go down as interest rates have been rising. So that's probably more of what you're going to see if interest rates keep going up. If they don't, utilities should probably do fine. But, if you look at over long periods of time, they do tend to have a good positively slope up. It's a relatively low risk investment. And, but you're not going to get a lot of sex appeal from it. You're not going to see 30, 40, 50% returns a year. Just, it doesn't happen. If you're lucky, maybe you get 12. But it's, the returns, depending when you mark them for this year, have been mediocre at best. You look at healthcare, also mediocre sector. Started the year off and has done poorly since. It's basically marked time since the war, but it's probably one of the worst performing sectors in the S&P 500 right now. And they were doing well prior. We had a good run at the end of last year and then hasn't done well. Now you look at technology. Wow, look at that. Technology. What should I invest in, Phil? Let me put it all on black. Look at this. As of January was right around here. And then pretty much as of April 1st, it went through the roof. It went from, this is the ETF, 131 up to like 190. Crazy, right? Well, you might think, well, technology, it always does well. Actually, there's a subsect in here. It's not even all technology. It's really only one sector, although software's come back a little bit. It's semiconductors. This is almost all due to semiconductors. Now, the technology sector makes up 30% of the S&P 500 index returns. So you're looking at a return of a market somewhere from 128 up to 190. You're looking at 60. So what is that? 30% returns, 35% returns, somewhere there.
That's almost 50%.
50%.
Yeah.
Okay. So 50% return. Okay. And that's in one sector with 30% of the S&P 500 returns, right? So 50%, 30%, you're looking what, 15% return just from technology. That's a lot, right? And so when you see this, you say, all right, well, maybe I should just put all my money in tech. Yeah, maybe. But really, when you look at it, it's all semis. So even software has come back a little bit, but it hasn't been due to software mostly. It's been due mainly to semiconductors. Just something to keep note. We're going to keep moving, but just wanted to point that out. So note this chart compared to everything else. Now, what's this? This is consumer discretionary. Also not doing very hot. Biden time, basically going sideways. Not a whole lot going on here. You also have communication sector, also not doing very well, just kind of going sideways. Not a lot to see here. You got the financials. Well, what does well in bull markets? Financials, you can't have a bull market without financials. Where are the financials? They're also not doing a whole heck of a lot. With the war, they were actually doing relatively poorly, and they've kind of come back and bided time a little bit. The problem with financials is they're highly attuned to interest rates and the yield curve. So if the yield curve is flat or inverted, financials don't make money. If you have a wide yield curve, they make a lot of money. That's for lending, not including all the trading they're doing that they have 100% accuracy on. We're talking about the lending. And so you notice financials haven't doing a whole hell of a lot, although they did a little bit better at a certain point, and it was pretty much from December. It was basically December until first of the year they did reasonable. Then they've done poorly since. So financials not doing a whole heck of a lot. And then you've got the energy sector, which obviously did pretty well. Starting in January is when it broke out, up until pretty much just before, as the end of March is when it kind of peaked out. So you had a strong trend prior to the war, and then about a month into the war, it kind of languished and went sideways. A lot of this has to do with Trump speak. Is the war going to end? It's not going to end. Here, I think at the end of March, he said, "Oh, the war's over. We're all set," and everyone thought, "Oh, the war's over, and so we're all set." And then they realized, "No, we're not." And then, so a lot of this is Trump speak. You can just kind of blame it on that. The energy sector, just like the utility sector, is very small and uninteresting in terms of the index. But that's a view of each different sector. Now, let's take some takeaways on this. And takeaways on this are virtually all of the returns are in energy, which makes up 3% of the index, and technology, which is pretty much all of it. So technology made up the returns for virtually the whole index for the year. Okay. Now, there's some stocks that are doing well for sure, but as an index, all these sectors come together to equal the returns of the actual index, right? And there's 11 different sectors. We didn't show you real estate because real estate's largely uninteresting, but either way, even if I did show it to you, it's a small part of the index. Okay. So now let's look at the index itself. What does this look like? This looks a lot like the technology sector. Now, if you're looking, this is the S&P 500. It pretty much didn't do all that much at the end of last year and the first few months, and then the war started, it went down, and then starting in April, it shot up almost entirely because of technology. So this is the influence of technology, is that sector. So is the market doing well? No. Semiconductors are doing well. Certain stocks are doing well. For the most part, most sectors are just biding time. A few aren't doing well. One is doing very well. The rest are just kind of biding time. So this entire performance here, almost entirely, is due to semiconductors. Okay. Here's the NASDAQ. Same thing, only more of an influence on technology. Okay. This is what the NASDAQ's been doing. That's exciting, isn't it? That's a really exciting chart. Let's put it all in technology. Mag 7 or bust once again. I wouldn't do that, but if you want to do that, I understand. Here's the small caps. Small caps are actually a lot more measured. So they've actually done reasonably well. Small caps don't have as much international exposure. But if you're looking at small caps, they're an interesting sector right now. Here's gold, right? All those of you who were in gold last year, it started to take off, did really well, and then did really well in like September up until January. And then you saw this huge drop off. That was not good. But basically, gold has also been biding time. Okay, you see this big triangle pattern. This is basically what's happened in the gold market, is just going sideways. Why? Because this shouldn't have happened, right? September until January, it shouldn't have done what it did. But when it does things like that, it just means that gold needs to go sideways to burn off that energy. At some point, I still think it's a bull market in gold. There's no reason for it not to be. But, that's obviously my opinion. But I see all the indicators point to it's still in a bull market. But it might take a year or two to start pulling up again. So by that time, people are going to forget about it. Be like, I've moved on to something else that's exciting. People aren't paying attention to gold. I personally like gold. I think it's going to be great. But I do think your money is just going sideways for maybe a year or two. We'll see what happens, but that's my suspicion. So I'm not expecting a whole lot of gold, whole lot out of the gold market right now. Here is the 30-year, the 20-year plus treasuries, 30-year treasuries. What's happening? A whole lot of nothing. But this was the freak out point. This is when people got freaky and they said, "Oh my God, interest rates are going to the moon. We're going to have inflation. Oh my God, things are going to be crazy." Um, that's that's not all that bad, right? It freaked people out, and then it came back, and now we're in this kind of sideways. This is kind of like the support area, right around here. You should feel perfectly comfortable. And if things trend worse, okay, but for the moment, this is kind of a fake out, and you might even start to see interest rates go lower from here. We'll see, but this is the long-term Treasury market. Not seeing a lot of action in the last year. We're also seeing the US dollar. Everyone who thought the dollar was going to go to zero, oh my God, I need to sell my dollars. I remember it was last year, I was getting a lot of calls from people who were like, oh my gosh, should I get out of my dollars? Look at this. Look at the chart. Nothing. No, you shouldn't get out of your dollars. Like there's no movement. By the way, I've deliberately not put numbers in here because I'm not trying to share the specific numbers. I'm trying to share the patterns. Is if you're looking at the patterns, this is more information than just looking at the numbers, because you're going to get pegged to the numbers and say, oh my God, this number is important. No, it's not. Look at the patterns. The pattern is sideways. It's been in a channel for over a year. So is this a trend? No, it's not a trend. The trend is sideways, which means that if you're betting on it going one way or the other, just basically short-term betting. It's not a trend. I would stay clear of the dollar. I would look at it for information, but nothing more. This is international markets. This is the MSCI EFI index, and I've just had some charts. You forgive these patterns I have on here, but this is part of the war, and then the war happened and went down, and now it's kind of back. So it was in a good trend, and if interest rates are lowering, if the dollar's getting weaker, if all those trends that were happening last year continue, then I do think international is in a good place. However, I do think we're in a tough spot because of the war. I would not touch international right now because of the war. I just think there's too much risk there. You have too many countries that are potentially at risk of currency issues, of inflation issues, of not getting enough energy, their economy getting sour. I would just be careful. Not saying there are countries that are doing well. I'm just saying be careful. It's not last year it was a no-brainer. This year, not so much. This year it's maybe I would need more information. Like emerging markets would be very suspect right now, except for the fact that the emerging market index is largely made up of stocks that are not going to be a problem. So while I'm fearful of emerging markets, the index is not going to show that because of the positions that are in there. So I just want to share all these positions just to show you what's actually going on in the markets. So you're not just looking at the index saying, oh, everything's great. No, it's not. It could be great. The rotation could happen when the war ends and certain sectors do well and certain ones won't. If that rotation happens, that's healthy. That's a good market. That's a market you can feel comfortable with. But until that happens, it's basically tech or bust. The question is, do you want to put chips on a gambit that could stop any day or not? I don't know. I think it's I think you're taking a risky bet at this point. Seeing all that, Phil, what are your thoughts?
So one thing I want to add, like about interest rates, that I do think is really interesting is if we go back, interest rate, we had an inverted yield curve, which means that the short-term rates were higher than long-term rates. The yield curve is normalized. It's not really steep. But like if I go on to the fixed income page on Schwab and I look at treasury rates, the longer the period, the higher the rate. So we've got a more normalized environment. So while when you showed that 20-year chart, you said it moved down and it's gone back and it hasn't changed a lot. But what is interesting to me about interest rates is that there have been changes below the surface because now we have a more normal yield curve. And I was reading that we always hear that when the yield curve inverts, that it means recession. And then we didn't have a recession with the inverted yield curve, but now there's some people say, well, it's not really the inversion that causes the recession. It's when we go back to normalization. We'll see if that really is what happens, because there's a lot of these things that we hear people say about the market, but that doesn't mean that they're actually going to be that way. But it is interesting to me to see the change in the shape of the yield curve. And you're right when you show all those sectors. It's not as healthy a market as we think. And if you went and looked at like the 52-week high and low list, you're not going to see everything hitting new highs, even though the S&P has hit a lot of new highs over the last month, right? Because it's driven by that one sector. We're not going to see the same percentage. You know, those companies hitting new highs. It's driven by tech, in particular, semiconductors. Not to recommend any stocks, but if you look at like Intel, I think is up 230% this year, or some number like that. And AMD is up over 100%, and Nvidia, which had been kind of trading in a narrow range, it's up not as much as the others, but like those three companies, there are other semiconductor companies, but those three companies are really dominating the index. But then if you go and look at like PE, which isn't the only way to value, to gauge value of a stock, but like Intel's PE is like 97. I don't know what AMD's is. And I'm, like I said, this is not for or against any of these stocks. I'm just kind of talking about what's going on. So people are expecting great things, right? That's what drives the price higher and gives them those kind of valuations, that people expect much more robust sales, much more robust activity, and they're betting on the future. And that's what's really driving semiconductors right now. And that's driven by what's going on with AI, because you need compute power and chips in order to drive AI. So like that's the thing that's back to driving the market. It was driving it for a while. Then we had some pullback because there were lots of concerns about DeepSeek and some other things. And now we're back to thinking that AI is that next big thing. And that's what's driving the market. And the semiconductors, which are so important to building up compute power, are really driving what's going on in the market. So we look at the S&P and say, oh, it's a great market, but it's very narrow in terms of what's leading it.
Yeah, and this picture is the yield, the 10-2 yield curve, just for reference. There's different parts of the yield curve, but this is, it's showing that the yield curve is flattening. And, it's not huge, but it's definitely flattening and has been for most of this year. So, that largely impacts the banks. And I agree with you, Phil. People say that the inverted yield curve, when it's inverted, it's like within 2 years, it's a recession. It's when it reverts back to normal within 2 years is when it does it. Because we had an inverted yield curve for many years.
Mm-hmm.
And I think we're probably going back to that point. I don't know when, but I suspect they're going to be going back to that point, because it seems to have done very well for the markets, and they seem to like that. And the banks don't seem to care, because they make all their money in trading anyway. So they're not lending anyway. But yeah, I think it's going to be a very interesting market. I mean, you look at mortgage rates are up. We've talked about this in the show. I mean, mortgage rates are up. Let me pull up some of these. So we've got, where is it? So the 30-year mortgage is about 6.5%. And earlier this year, it cut down to 6.
Yeah.
I mean, I bought a house back in September. It was at 6. It was like 6 1/8. I think in early March, it went down to 6 or just below 6. The 15 years, 5.87, also similarly. So we don't see mortgage rates are going up at the moment, which is not good for housing.
No.
You've got, let me see what else we got here. Oil's kind of come down, but yeah, I mean, we've talked about this a few weeks ago, and I'll mention again, like the words are still patience and caution. We've got SpaceX IPO potentially coming out in another 3 weeks. If I had to guess, I would guess that we might see some money flooding in running up to that. And then maybe after that, it'd be a little more quiet, but the markets are quiet now. It's basically technology. So the question is, do you want to bet on technology or not? That's really the big question. I mean, if you look at today, I just noticed this, the software stocks are up. The software ETF is up 5.5% today. Why? Well, Microsoft is up. I think I saw Microsoft's up like 4.5% or something crazy. I don't know why. 3.5% now. I don't know why, but software was not doing well because people were afraid of AI. They're afraid AI was going to kill the business model, which I think it will, This is not going to happen today, but at some point it'll impact it. We'll see what happens. But I think the markets overall just said, we don't care. We just need to put money somewhere. I think the biggest risk in the market right now is money flows. There's too much money floating around the market, so that in an ordinary year, this would probably be a relatively flat market, which is what we predicted on the show, is that we would have a volatile but flat market this year. And what we saw was that excess money flows is flooding into one area or another. When it started the year in precious metals, then went out, it went into energy stocks and went into materials, and it went into staples. Those were some of the best performers earlier in the year. And then at the war, it all went into oil prices and energy stocks and delevered, and then it went back into semis. So right now everything's in semiconductors. Maybe it's getting into technology overall, but the money's got to go somewhere. And you have this excess money, it's going to go somewhere. It's not going other places, which to me is a concerning sign. I want to see the broad market going up. That's a good sign. But when you basically have a handful of sectors going up, because that's the only place that's going up, so everybody's putting their money there, it's this positive flywheel. At some time, people run out of money and they stop putting money there. And then they say, all right, well, where else are we going to put it? Well, I don't know. Earnings aren't going to be good next season, next quarter. So what are we going to do with it? Sit in the sidelines. You're getting 4 to 4.5% on your bonds. I know that's not a sexy return, but it's a hell of a lot better than losing money. If you get 0% on your equities, maybe you get 4%, but you're taking equity-like risk. Do you want to take equity-like risk to make 4%, or do you just want to make 4% virtually risk-free? I know which one I would take. If you look at, I'm just going to show this one other thing, and then here we go. Equity risk premiums. I don't know if you've noticed this, Phil. What are your thoughts on this one?
Negative territory. That's not where I want to be.
That's why there's a red arrow there with a big circle around it.
And I want to be compensated for my risk. And so you want a positive equity risk premium, not negative, because that means you're not being compensated to take risk. So as you said, 4% on a risk-free bond, like a treasury, is a lot better place to be than to put it into equity where you could potentially have a negative return related to that.
So for the listeners who aren't familiar with equity risk premiums, I'll give you a quick summary of what this chart is. This chart is the S&P earnings yield minus the 10-year treasury yield. So effectively, if it's negative, it means your 10-year treasury yield will yield you more than your S&P 500 earnings yield. Now, the S&P 500 earnings yield should, reward you if you're in equities versus bonds. And if it's negative, it should reward bonds over equities. Now, pretty much for the last year or so, it's been negative. And what that shows is that bonds should perform better than equities over long periods of time. Obviously, that has not necessarily happened, but over long periods of time, that's exactly what should happen. Now, as interest rates rise and earning yields don't rise, then this just gets more and more negative. And you see, the last time this happened was in the Great Financial Crisis, coincidentally. So what this tells you is that bonds are actually pretty attractive at this point compared to equities. So for people looking to get retirement income, this ain't bad. I wouldn't go out too far, but because you're not getting rewarded for 10 years versus 30 days. But you can do short-term treasuries and get 4% virtually risk-free, right? There's a tiny bit of risk that the U.S. government will default, but as long as you hold to maturity, the risk isn't there. So looking at this should give you pause. This doesn't mean put all your money under the mattress. This just means this should give you pause. Now, if you see the returns in the equity markets minus semis, you're kind of getting something similar. You're getting a sideways movement with not a lot of progress. We'll see if this changes. I suspect it might. It seems like yields are going up and earnings yields are probably declining. Maybe not declining, but going sideways. They'll probably decline next quarter, so that won't look good. But just something to keep in mind. There's not a whole lot of air. I know there's like perma bulls out there and perma bears. You shouldn't be either one of those. But every time you look at some of these areas, you want to be really focused on what are my risks. And right now, the risk is, am I getting paid for taking risk in equities? Not really. Not today. Not at this moment. Could that change when we have rotation into other areas? Maybe. But at the moment, patience and caution are still the words of the day. Why don't you wrap us up here, Phil? Final thoughts and take us home.
Sure. So, in general, when it comes to investing, make sure that you're informed. Take a look, understand what's going on. We talked about a lot of interesting things, I think, today. Some things to keep in mind, like don't just look at the headline numbers, look underneath. I think that's a really important part of it. And also, don't just, I always come back to confirmation bias too. Don't just find people that agree with you. Look for people that have that are coming at it from the other side, because that can help you understand better. And maybe you don't agree with them, but at least understand where they're coming from. For me, I'm Phil Weiss. I know experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. You can visit our website at Apprise Wealth, that's APPRISE wealth.com, to read and sign up for our weekly blog. Thanks for having me today, Kirk. Enjoy the conversation. I think we covered a number of important topics.
Yeah. Well, thanks for coming on, Phil. Always enjoy having you on the show. And that's the show for this week. Thanks again for joining us. Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app for your choosing. You can also check out our show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a share rating and comment in the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email and express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.